Talk a little bit more about all of this, including the challenges facing global central banks, especially the Federal Reserve, and whether they will follow suit. We are joined now by Rick Rieder, Chief Investment Officer of the Global Fixed Income Fund at BlackRock and head of course, the firm's global allocation team. We'll talk about George Soros in a minute, Rick, but before we do that, let's talk a little bit about what the ECB is doing and what you think Jay Powell is now thinking.
Listen, I think what the ECB is doing is the right thing. I mean, they are moderating their amount of purchases. I mean, they're moving a bit back from emergency conditions, as Steve said. You know, take that number down from 80 billion to 70 billion. You're still talking about immense amounts of quantitative easing going to the system, but recognizing that the system can pull back a bit from the emergency infusions of liquidity you've seen. By the same thing you've seen the Bank of England, Bank of Canada, Korea's doing it. Listen, I think the Fed, I think time has come that we can move off of emergency conditions. Listen, the system is stuffed with liquidity. And I think the ECB is doing is recognizing, gosh, you can pull back. I mean, it's still immense liquidity. I also think there's something very important I think Christine Lagarde is referring to. They are still far away from their inflation targets. So rates are going to stay low. The quantitative easing is going to stay high for a period of time. But can you pull back a bit from the emergency conditions? Absolutely. And I think we're seeing that.
Throw in Delta, COVID and Delta. You're starting to see what some of the airlines are saying about what it may mean for the economy come this fall. Do you think that changes the equation at all in what's going on in Jay Powell's mind?
So, Andrew, I think it's a great question because you think about it. I think there's two things that are impacting the economy. There's no doubt, and by the way, you saw this, I think Steve Leisman described this in the Beige Book yesterday, the travel sector, the leisure sector, restaurants. Are people going to be a bit more cautious going forward around, gosh, do I want to be in crowded indoor locations for a period of time? That clearly is creating some moderation of the economy. Second part of what's moderating the economy is the supply side of the equation. You read through the Beige Book or the ISM data or corporate earnings data, there's an input problem in the system. By the way, there's a people input problem. There's not enough people to fulfill the jobs that are out there. There's supply chains, there's semiconductor issues. So you have two factors. You have no doubt you have variant, some caution around variant. No doubt you have some supply factors. You think about what monetary policy does, what it's done for, gosh, the 35 years I've been doing this. It modulates demand. None of those factors are affected by monetary policy. The amount of stimulus that's in the system today is immense. Consumers are flushed with cash. They've delevered. Their house is in great shape from a price point of view. Companies are flushed with cash. They've delevered. So the impetus for demand will continue. Demand in the economy is really strong. The Fed shouldn't try and modulate that at all. It's the supply side and it's COVID, and those will work its way through. So should the Fed be tapering? Absolutely. Will the Fed de-link tapering from interest rates? Yes. I mean, interest rates are going to stay low for a long time. Does a 10-year note need to stay at 1.35%? I think Lee Cooperman said it earlier. Then that's not the right price relative to an economy that's growing at 6-ish% this year.
What a nice segue, because what I wanted to do was actually show you that comment from Lee this morning. Wanted to get your take on his comment from earlier this hour. Take a listen to what he said.
My favorite idea is very ironic, is a bond. I think bonds are totally mispriced. We're talking about a big negative interest rate in the 10-year and in the short-term paper. And I think it's a bunch of academicians, running monetary policy around the world. This negative interest rate stuff is ridiculous. The idea of buying 10-year German bonds and getting less back in 10 years than you give them today, I don't get it. I don't get it. I really don't get it at all.
You get it?
There's a lot to unpack there. Lee's a smart guy. So let's talk about a couple of things. I totally agree with this dynamic that interest rates don't need to stay here, and they shouldn't. And it's quality assets. What's happening because of the QE is you're creating a crowding out of quality assets. There's investment going in at the wrong real rates relative to the rate of inflation. I think we could pull back on this liquidity. I think it's a bit overdone. Listen, there's still opportunities in fixed income, and it's in parts of the credit market, the securitized market, bespoke financing. There's still some bonds that make sense, but the real rates, quality assets, and by the way, the front end of the yield curve where the Fed is largely operating, there's no collateral. And so, I think there's something that's really important to think about. The demand for income is greater than anything anybody's seen in our generation. If the Fed pulls back on the liquidity infusion, insurance companies, pension funds, individuals, banks, Japan, are all big buyers of interest rates. Rates aren't going that much higher. By the way, look at what the ECB did today. You modulate down the purchases and rates rally. Rates aren't going that far back, but we should let them move back a little bit from where they are today because the real rate is just price strong today relative to what economic conditions are.